I'm curious about, I was talking about, how your faith has guided you in terms of the specific investments that you make, whether it's a Tesla, whether it's Bitcoin, whether it's, a biopharma company.
Right. So we are seeking the truth as these new technologies evolve, all of them at the same time, and cause like a lot of chaos, a lot of confusion, a lot of FUD, fear, uncertainty, and doubt in our markets. And we're trying to allocate capital to its highest and best use, do the right thing.
How hard was it in the early days? And you essentially bootstrapped it, for 3 years?
Yes.
And you had people working at home, right?
No, we all worked in an office.
Oh, you all worked in an office,
We worked in an office, yes.
But how hard was it?
That was a very important part of coming together. The bonds that we created during that time will never leave us. So how was it in the early days? We were on a mission. And I never thought we were going to fail. Many other people thought we were going to fail.
Right.
I remember Eric Balchunas is very kind in the beginning. He's very kind and says
Bloomberg follows
at
ETFs.
Bloomberg he's I think your top ETF journalist, and he really thought we were destined for failure, and basically told me so in a very nice way, but I just didn't believe that. And one of the reasons people thought we were going to fail is here we chose a wrapper that was dominated by passive portfolios and put an active strategy in there, and people thought that was crazy. Now, after 2.5 years of no traction, effectively, I began to say, "Wow, was that a bad move?" And so we started doing separately managed accounts and so forth. But it turns out that was a great decision because so many people thought it was such an awful decision.
Right.
We had so much visibility that when we started to gain traction, when the inflows started, it was like a head fake, and it got us so much more attention than we would have gotten otherwise.
I mean, what were institutional investors saying to you in the early days when you made your pitch?
Too volatile. That was the pitch. I mean, that was the response. Too volatile. We couldn't possibly do that. And here we are. We are a volatile strategy,
right?
And our response was, well, volatility on the upside is not a bad thing.
Right.
But the other thing we said at the time, and we actually took our cues from a value investor who said to us, "I would never buy one stock in your portfolio, but I like your research and you might be right, so I'm going to just put 5%. This is a value investor, 5% as a hedge. And as did our first institutional investor, which is value-oriented,
right.
And kind of thought we were behaving like a value manager, long-term time horizon, and looking for extreme values. Well, value investors are using price to book and dividend yield and that sort of thing. We're using growth. We're using spectacular growth rates that no one is expecting. And Tesla was our first proof of concept, I would say, a very visible one, where people were saying, what are they talking about? And all we had done was used Wright's Law, which is the centerpiece of our research, to try and figure out how quickly costs would decline in battery pack systems, and therefore how much prices would fall for electric vehicles and how quickly the uptake would be. And we saw Elon Musk, magnificent things happening in terms of
But it wasn't
costs.
so easy to be invested in Tesla early on.
For us, it was easy.
Because you just believed the story, or?
The most important call that we made initially with Tesla was, all right, Tesla's battery technology is unlike any other auto manufacturer's battery technology. Tesla was riding down the cost curve of the consumer electronics industry. So laptops, cell phones, huge volumes, right? And when you get a scaling like that, costs come down. It's called a learning curve in the tech industry. So Elon, you had auto manufacturers and auto analysts laughing at him. Elon is building his car on top of cell phone batteries. Isn't that funny? And what they didn't believe was that the engineering was possible.
Right.
So there was it wasn't, they just didn't think it was possible. And he did. And so even today, these cylindrical batteries that he's been using relative to lithium-ion pouch, lower cost and will remain lower cost for at least 3 years, we think, which means that any other auto manufacturer who wants the same performance and the same range at the same price will have to lose money on every car sold.
So it keeps him in a really great position.
And that's
what
only
you're
one
saying.
of 4 barriers
of
to
4.
entry.
Well,
But that was the first call we had to make.
so Elon Musk and Tesla. So there is a point that you would get out. I know there's a story you've talked about. You put a mark on the stock price. I think it was 3,000.
Yeah, 3,000 is our base case, not our bull case, but our base case.
Okay, so there is a point where you could say, okay, I'm moving on. You've gotten out of Apple. Mm-hmm. I mean, these are backward-looking companies or technologies that you don't think are, or not necessarily?
Not necessarily. They are very well understood. Their dynamics are well understood. They are the FANGs.
Right.
They're well owned. And we just want our clients to be exposed to the next FANGs, which are not going to be in the FANG category, but the next FANGs. And Tesla's becoming a FANG. You know, I think
Right.
it'll end up in that grouping at some point. So our minimum hurdle rate of return expectation for a stock is 15% at an annualized rate over 5 years. So a doubling over 5 years. Tesla is about nearly a quadrupling over 5 years, so
Right.
well within our range. So, you know, we have been taking profits, and that's because Tesla in here, I think it's becoming very obvious now that electric vehicles are taking massive share from traditional gas-powered vehicles. And so the stock finally is responding to that reality, because that has
Had a
been
significant
true.
bounce back.
Yes, it has. Whereas much of our portfolio has still been in a bit of a weak spot.
So what's the moonshot we should be thinking about? I did an interesting panel here about longevity and technology and just talking about different types of technologies that are out there. What is the Tesla of tomorrow? What is the Apple of tomorrow? I mean, obviously we don't know, but what is it in terms of the general technologies? You guys do the research that we should be thinking about.
We were assuming that in the next 10 years, artificial intelligence would deliver a market cap opportunity of $30 trillion, okay? From tens of billions today. Our new number is 80 trillion. And from tens of billions today. So we think that is the big new frontier, but it's going to be in transportation, autonomous taxi technology, autonomous trucks, drones, and so forth. It is in genomics, and so it's going to make these platforms come alive and evolve much faster than even we thought was possible.
Right.
I mean, this 30 trillion was a 2 year ago number. Now we're up to,
amazing, it's doubled.
now we're
Or
almost
some,
tripled.